So mainly the two biggest variables are U.S. and Chinese policy, right? So the U.S. has been drawing down the Strategic Petroleum Reserve, and that's quelled some of the supply side shortages in energy markets. So I think that the number one context is that there's not a lot of spare capacity, right? OPEC does not have a lot of spare capacity. Shale can only grow so quickly. We might starting to see some Russian energy come off the market in the years ahead. And there's still strong growth from emerging market energy consumption perspective, right? India still wants more energy every year, and so there's kind of a supply side issue, and then there's we can only draw down the Strategic Petroleum Reserve for so long. I think we're probably getting towards the end of that cycle, and so that can put upward pressure on prices. And then number two is China, right? So if you look at Chinese retail consumption, construction activity over the past 2-3 years, it's been very stagnant. It's partially due to the unending rolling lockdowns they keep doing, and it's also due to kind of a planned demolition of excessive leverage in the real estate market. They have kind of a top-down plan to rein some of that in. They go through cycles, but this one's been particularly austere in that area. So the combination of deleveraging and these lockdown procedures are reducing overall Chinese energy consumption compared to the prior trend, compared to the baseline. So if they ever reverse those policies, if they do more stimulus, if they do more reopening and stay open, that's an uptick in energy demand, oil demand, and so I think those are the variables to watch. Right now, there's kind of both tight supply and demand destruction, just from Fed tightening policy, Chinese lockdowns, and if those in the next couple of years, if that turns into the next upswing, that's where I'd be pretty concerned about higher energy prices. They've basically, I think it was the president there said, is like houses are for living and not speculating in. People watching this probably know that China has a lot of very high valuations and a lot of leverage in its real estate sector. That's been kind of a known long-term issue, and policymakers there have been trying to rein that in. There have been a number of defaults, and rather than jumping in with stimulus and bailouts and things like that, they obviously try to rein in the speed with which things come down and spread it out a little bit. But they've not, they've been pretty much letting defaults happen and letting deleveraging occur to somewhat keep the strength of the currency and kind of clear out some of that leverage. And so that's something they have been pretty explicit about. That's kind of a separate issue than the whole ongoing lockdown thing. So those are kind of two simultaneous variables that are reining in Chinese overall consumption. Yeah, so I'm not an expert on Chinese domestic policy. There are people, there are China watchers, for example, that cover that a lot more extensively than I do. I actually would have expected that they probably would have opened before their national congress. Yeah, you would think that they would want a strong economy leading up to that, but they just kept that going, all the way up to that. There are fresh reports now that they're kind of aiming for the first half of 2023 for more of a reopening, but we'll see how persistent that is. Right now, they kind of have this little spike in cases, so I wouldn't expect it right away. But it does look like they might be planning it. I think they can only kind of go so long with deleveraging and this kind of stagnation that they're in before they would risk less and less public buy-in about what they're doing. So my guess is next year, but I don't have a strong view. And as for their intentions, I mean, it is complicated because they use zero COVID and low cases as a supposed example of why their economic model and political model is better than the West. They basically, so it's kind of like once they stick with it, now they're stuck with it optically, right? And so it's hard to pivot out of that. And I think they have to navigate a way to pivot out of that. That's number one. And then number two, I mean, I have some Chinese contacts there, and I mean, there's some percentage population that supports it. I mean, even some of the public buys into, that vision. And so I think it's one of those things that over time, public opinion shifts. If they realize that variants are getting more mild, it's almost impossible to do zero COVID, and that the economic stress keeps building. And so that the whole cost to benefit keeps worsening and more people kind of turn against it. So I think they're probably going to pivot out of that next year. But like I said, I would have expected it this year. And as for other motivations, some people suspect that it's to keep a lid on energy and inflation. to some extent, and other ones view it as kind of almost a purposeful disruption of the West, right? Because those supply chain limitations trickle into us as well. But I generally use Occam's razor here, so I think the simplest explanation is more likely to be correct. But again, I don't focus heavily on Chinese domestic policies other than the basics.
Right.
Yeah, or at least you're reducing the marginal ability for China to ease some of those supply chain restrictions. Although we have seen general trend improvements, obviously compared to the worst stages of the crisis in terms of logistics. So I'm structurally long energy, so I try not to trade it too much. I just I own a number of energy producers. I own pipelines. I plan on holding them for probably 5 years or more. If we do start to see an uptick in economic activity, and I could, for example, lean more into that, right? So I would position based on what's happening right now. We're still in a kind of in the U.S. at least, we're in a demand destruction cycle. Tight Fed, declining PMI, so Purchasing Managers Index, overall slowing economic activity, inverted yield curve, potential 2023 recession. So, I think that we have to right now kind of balance that supply side with the demand side, watch for signals, watch for pricing, watch for economic activity, see what happens. And if we do start to get that next upcycle in economic activity while we still have energy constraints, that I'd be quite bullish. But even between here and there, I'm still I don't get out of my energy positions. So I use the majority of it for physical. I use it primarily as a defensive asset, as a bearer asset, store of value. But I also go into because I don't focus on the small caps. I don't have a background in geology or it's not an industry that I go deep on, right? So I focus on the larger players. I focus on the royalty companies. One thing to be mindful of is if you are bullish on energy, that's a significant cost for the miners, but it's not really a cost for the royalty companies. So, for example, if someone has an expectation where they expect gold to go high, but not energy, then the miners would be very well positioned. You get them at lower valuations. That's pretty attractive. If you expect both gold and energy to go up, then the ones that don't have their costs affected, like royalty companies, will probably be better positioned. But of course, you're paying a much higher valuation for that view. And so I like a mix of both. Overall, I kind of I overweight the royalty companies, but I still have a number of miners as well. So this year I've been emphasizing defense. So short-term like cash equivalents, healthcare stocks. I've been in energy and then also energy pipelines, which are somewhat lower beta and more income focused play on the energy sector. It's more about volumes than prices. And in prior cycles, those pipelines were anything but safe. I mean, they had too much leverage. A lot of them performed very poorly. They were overvalued. But after the 2020 washout in that space, I consider them to be pretty low risk. And so I've been in that space. Where I play offense is things like I have say Brazilian equities, some Indian equities. So there's select emerging markets that I like. Ironically, the Brazilian currency's held up better than many. It's been one of the top performing currencies this year because their central bank's been pretty hawkish. I also I have a kind of a permanent slice of a Bitcoin allocation. Other defensive assets include precious metals and just real estate with a low fixed mortgage attached to it. So overall, I'm on the defensive side, but I still take pockets of risk and volatility.